Hello, my name's Matthew Kidman. I'm here today with two of the sharpest brains in the Australian equity market, Roger Montgomery from the Montgomery Fund and Don Williams from Platypus Asset Management. Welcome, gentlemen. One of the burning issues at the moment in the Australian equity market is the Murray Review and how it's affecting the banks, with the prospects of the banks having to hold higher amounts of capital. Their share price subsequently have fallen quite dramatically in the last month or so. We'd like to discuss it today. Roger, what do you think the outcome of the Murray Review will be?
Okay, well, I think that what will change is the risk weightings to mortgages. That'll be the big change. Yes, there's the prospect of increased capital adequacy requirements for the big banks, so sort of a once and for all shoring up of the banking system, so 100 or 200 basis point increase in their capital requirements. The outcome, though, will ultimately be a levelling of the playing field between the regional banks and the big banks. So what will actually happen is that the larger banks will require more capital, which will lower their ability to leverage that capital onto mortgages. So in effect, the banks like Bendigo Bank will actually be able to leverage more of their capital with respect to the big banks.
So let's stick with the four big ones. Is that a negative? Or it's not?
They'll have to raise capital they'll have to issue shares if they are required to raise their capital adequacy requirements by 100 or 200 basis points, and that's obviously a negative because it's dilutionary.
Okay, Don, you think it's a negative? Are you agreeing with Roger?
Look, yeah, it is a negative, but it's a relatively small negative in the scheme of things. We think. I mean, the banks have corrected, circa 10%, a bit more. Some of them, they were overvalued a month or two ago. So they've come back to some sort of reasonable value now. But I think, ultimately how it plays out for the banks depends on how much of that additional impost, if you like, they can pass through to their customers.
So if we put that into perspective, down 10% or thereabouts, do we buy now or do we wait for the opportunity when they do raise money?
Well, short term they're a buy because they're coming into their dividend period. But longer term, we would argue there's better places to put your money in the Australian market than the banks.
Do you agree with that, Roger?
I do. In fact, we only own one of the banks, and that's the ANZ. And we've always thought, well, most recently we've thought they were too expensive. So we haven't had any exposure to them. The big opportunity, I say again, is looking at these regional banks. They don't touch the sides of the big banks in terms of their market shares, but a levelling of the playing field, particularly for those that are actually working with APRA to become advanced banks. So they not only get the benefit of the changes to the from the Murray inquiry, but they're already moving to lower capital adequacy or higher leverage of their mortgages. So that's I think where the opportunities lie.
Do you like those smaller regional banks, Tom?
Yeah, we do. They're relatively illiquid. They can be hard to get in and out of, but they should have a higher growth rate than the majors, definitely.
Okay, not much love for the four big banks here today.